Your attention, please. So today, I sent you an email in the morning. Have you got it? Okay, beautiful. So today we are going to see how to do simple and full information forecasting and valuation. Okay, in the first part, we are going to see simple forecasting and valuation. In the second part, we are going to incorporate other information and do full information forecasting and valuation, and see also how to do pro forma analysis, or how to perform or forecast the financial statements of a firm. Simple forecasting grounds the speculative forecasting in what we know from the financial statements. The assumption here is that the present is a good indicator of the future. According to simple forecasts or simple forecasting, we can convert our simple forecast into a simple valuation using a simple or a simple version of one of the valuation models, such as, for example, the residual operating income model, where the value of equity at time 0 is equal to the book value of equity at time 0 plus the capitalized residual operating income expected in year 1, assuming that this residual operating income will be growing at a constant growth rate forever. Okay? So this growth rate is an average growth rate for the future. Note that it is very easy to do this kind of forecast and valuation. Date 0 items are readily available. From the financial statements, we can obtain the current book value of equity. And in order to forecast the residual operating income in year 1, we also need the current net operating assets. The expected operating income in year 1 can be also easily forecasted using our current financial statements. The growth rate also can be forecasted from the financial statements. We can use, for example, the growth rate in the net operating assets over the past few years, or the growth rate of sales, something like that. Of course, we can use two-period model, but this simple model is a summary, or because we assume that the growth rate will be an average growth rate for all future sub-periods. Okay? Now let us see how to do simple forecast and valuation using a dummy firm called PPE. PPE, this is the name of the firm, but also it tells us that this firm has a lot of property, plant, and equipment. So it is mainly, its assets are mainly composed of property, plant, and equipment. So we have the following balance sheet. We have the balance sheet for year 0. Year 0 means now, and the prior year. We also have liabilities and equity for year 0 and the prior year. We also assume that we have the income statement for year 0 and also the statement of cash flow. For simplicity, we ignore the tax here, or we can assume that this gross profit minus this is the operating profit. We assume for simplicity that this is the operating profit on after-tax basis, and this is the net financial expense on after-tax basis. And this is the earnings or comprehensive income. Note that it is assumed that the cost of capital for this firm is 10% and the cost of debt is 4%. If this is the case, the net financial expense for year 0 is equal to the cost of debt times the beginning of period NFO. This is the beginning of period NFO, okay? So this is the required return on debt on after-tax basis, of course, times the NFO at time t minus 1, okay? Note also that the statement of cash flow can be calculated from the balance sheet and the income statement. This is the operating income plus depreciation. This plus this gives us gives us the cash flow from operation. This is C. And we can easily also calculate I. I here is equal to the amount of depreciation plus 4.5. This is the change. This is the change in the net property, plant, and equipment. This one. This minus this gives you 4.5. Okay? Adding the amount of depreciation, this will give you how much investment was made from last year until this year, okay? Now, C minus I gives us the free cash flow. Note also that we have net dividends paid is 5.3, calculated as earnings 9.5 minus the change in common shareholders' equity. 9.5 minus the difference between 66.7 and 62.5. The difference, this minus this, is the addition to equity. Remember that earnings can be split between dividends and addition to equity. Make sense? So if the increase in equity is from here to here, then earnings minus the change from here to here gives us the amount paid out to shareholders. Make sense? Okay. Under simple forecasting and valuation, we can make many assumptions. For example, if you believe that there will be no growth in the residual operating income, in this case, the residual operating income in any year in the future is equal to the residual operating income in the former year. So residual operating income in year 1 will be equal to the current residual operating income. The implication of this, if this is the case, if we believe that this is the case, it means also that any addition to net operating assets will just earn the required return on operations. This is the implication. And according to this assumption, operating income next year, here we are talking about core items, okay? We are talking about core items. Operating income next year is equal to current operating income. We are talking about the core here. The current operating income for this year plus the product of the required return on operations and the addition to operations. So this is the required return on operations, and this is the change in the net operating assets at time 0. The change is the addition to net operating assets. So we assume that any addition to net operating assets will earn the required return. adding this to the current operating income means that next year residual operating income is equal to current year's residual operating income. Make sense? The same applies to the earnings and residual earnings. It is according to this assumption, next year's earnings in year one is equal to current year's earnings plus the product of the required return on equity and the addition to common equity. If this is the case, then next year residual operating income will be equal to this year's residual operating income. Okay? So for our dummy firm, operating income in year one is equal to operating income in year zero plus the required return on operations times the change in net operating assets at time zero. So this is the operating income in year zero plus the required return or the product of the cost of capital and the change in net operating assets. So 4.5 is the change from here to here, this minus this, okay? So this is the expected operating income. The interest expense or net financial expense is equal to, this is for year one, okay? And year one is equal to NFO in year zero times the required return on debt. So this is the net financial expense for year one. The difference, of course, gives us the earnings expected in year one. Now, if we calculate the residual operating income at time zero, the residual operating income, remove this parenthesis, no need for this one. No need. The residual operating income in year zero is equal to operating income, this is the operating income in year zero, minus the product of the cost of capital and the net operating assets at time -1. -1 means former year. If we are using zero, zero means current year, -1 means last year, okay? And this one, the residual operating income in year one is equal to the operating income expected in year one minus the product of the cost of capital and the net operating assets in year zero. As we can see, the two residual operating income are the same. There is no growth in the residual operating income. Okay? There is a growth in the operating income. As you can see, last year or this year's operating income was 9.8. Next year it is 10.25. So there is a growth in the operating income and earnings also. But there is no growth in the residual operating income. Okay? Okay. If this is the case, if we believe that our firm exhibits something like this, in this case we can value the firm easily. The value of the firm at time zero is equal to the book value of its net operating assets at time zero, plus the capitalized residual operating income, where we capitalize the residual operating income using the perpetuity formula. So we divide the expected residual operating income by the required rate of return, and then we add the result to the current book value of net operating assets. So this is the value of the firm, or the value of its operations, okay? Once we have valued the firm, we can easily value its equity by subtracting the NFO from the value of operation, and we get the value of equity. Make sense? Any questions? Okay. This is another realistic example. Our beloved firm, Nike. In 2010, the cost of capital was 9.1%. Core operating income in 2010, the core operating income was 1911. Net operating assets in 2009 was so-and-so, and in 2010 it was so-and-so. The core residual operating income in 2010, residual operating income is equal to the difference between the operating income in that year, this one, and the product of the cost of capital and the lagged net operating assets. So this is the operating income in 2010. This is the cost of capital. This is the net operating assets in 2009. Okay? So this is the formula we use here. At time t is equal to operating income at time t minus the product of the cost of capital and net operating assets at time t minus 1. Okay? The no growth forecast of operating income, we are forecasting the operating income for 2011. In 2011, call it t plus 1. Let us call it t plus 1 here, huh? T plus 1, or in period 1, for example, it is equal to operating income in year 0 plus the product of the cost of capital and the change in net operating assets. So this is the operating income in year 0 or in 2010 plus the product of the cost of capital, and this is negative 832 is the change in net operating assets. The change in net operating assets. Net operating assets in 2010, this one, minus net operating assets in 2009, this one. So this minus this gives you negative 832. Make sense? Make sense to you? Okay. Now once we have forecasted the operating income, we can easily forecast the residual operating income. The residual operating income for 2011 is equal to the forecasted operating income, this one, calculated here. So this is the forecasted operating income minus the product of the cost of capital and the net operating assets in 2010. Okay? We just apply the formulas, but be careful to use the correct timing. Okay? The value of equity for this firm in 2010 is equal to the book value of equity in 2010 plus the capitalized residual operating income, assuming no growth. So we divide the expected, this is the expected residual operating income in 2011, we divide it by the cost of capital, and we add the result to the book value of equity at that time, and this gives us the value of equity. Then we divide this value by the number of shares outstanding, and we get the value per share. Remember that the value of net operating assets is equal to value of equity plus value of NFO. So the value of net operating assets, if we want to calculate the value of net operating assets, it is equal to what? If we know the value of equity, then we can easily calculate the value of net operating assets. It's equal to value of equity plus the value of net financial obligations. However, in that year, the firm had net financial assets, and therefore, instead of adding, we subtract. So we use minus NFA rather than plus NFO. Okay? The firm had an FA rather than an FO, so we subtract rather than adding. Okay? Alternatively, we can apply this formula to value the firm. The value of the net operating assets in that year is equal to the book value of net operating assets at that time plus the capitalized residual operating income. We will get the same value here. Now this is the value obtained assuming no growth, and this is the observed market price. The difference is too big. The difference is too big. Definitely the market factors in growth potential for this firm. We are not incorporating the growth potential of this firm, so we should take into consideration its growth potential. Now, if you believe that the firm will be growing, for example, at a constant growth rate, it is assumed here that next year's return on net operating assets is similar to this year's return on net operating assets. Okay, so this is a simple assumption. Okay, it is assumed that the return on net operating assets for next year is similar to the return on net operating assets for this year. Again, we are talking here about core ratios. We should use core ratios in the valuation. Make sense? So according to this assumption, operating income in year one expected is equal to the product of the current return on net operating assets and the current net operating assets. And the formula for the residual earnings in year, the residual operating income, this is the formula for the residual operating income. Okay? The residual operating income in year one, note that the formula, original formula says that the residual operating income in year one is equal to the return on net operating assets in year one minus the cost of capital. The difference is multiplied by net operating assets at time zero. However, if we assume that this one in year one will be similar to this one in year zero, in this case we plug this one here instead of this one, and we end up with this formula. So the residual operating income in year one is equal to the current return on net operating assets minus the cost of capital. The difference is multiplied by the current net operating assets. Okay? And the same applies if we are forecasting earnings and the residual earnings. Here we are calculating the residual earnings in year one. Okay? So for our dummy firm, the current core return on net operating assets, this is the return on net operating assets at time zero, it is equal to operating income at time zero divided by net operating assets at time -1, okay? Lagged. So this is the operating income for year zero. This is the past year net operating assets, okay? So this is the current return on net operating assets. If this is the case, we multiply this one, we multiply the current return on net operating assets by the net operating assets at time zero. So we apply this formula. So we are calculating operating income in year one. Operating income in year one is equal to the current return on net operating assets times the current net operating assets. And this gives us the forecasted or the expected operating income. Make sense? Okay? The interest expense in year one, again, in year one, it is equal to net financial obligations in year 0 times the after-tax cost of debt, and earnings is the difference between this and this. Okay? As you can see, residual operating income in year 1 is equal to operating income in year 1 minus the product of the cost of capital and net operating assets, in year 0. This one. So this is operating income in year 1 minus the product of the cost of capital and the net operating assets at time 0. Alternatively, you can calculate it as the difference between the current return on net operating assets using this formula here. We are using this formula. And the cost of capital multiplied by the current net operating assets at time 0. We are using this formula. We get the same answer. Make sense? This one is greater than the no growth assumption. The no growth assumption, the residual operating income was 2.81. Make sense? When we assume there is a growth, then the residual operating income will be greater than the no growth assumption. How much the growth rate? The growth rate or the growth is equal to residual operating income in year 1 divided by residual, this is 1 plus the growth, okay, divided by the residual operating income at time 0. So this is the formula. This is the formula for the residual operating income in year 1 here, divided by the residual operating income in year 0. Okay? Make sense? However, because under the growth assumption, it is assumed that the return on net operating assets in year 1 will be equal to the return on net operating assets at time 0. If this is the case, then we can cross this against this and this against this, and we end up with this one divided by this one. Right? Make sense? If this is the case, then the growth rate in the residual operating income is just equal to the growth rate in the net operating assets. Make sense? So G for our dummy frame is equal to, this is the net operating assets in year 0 divided by net operating assets -1. So it is 1 plus or 1.06444. So G, the growth rate in the residual operating income is 6.44%. Make sense? Any questions? Any problems? Ask me, please. I am happy to repeat any part. Ask me. So if you believe this growth will be sustained into the future forever, so we can value the firm as follows. The value at time 0 is equal to the book value at time 0 of the net operating assets plus the capitalized residual operating income, assuming a constant growth in the residual operating income. So this is the value of the firm. Subtracting NFO, we get the value of its equity. Alternatively, if you believe the growth rate in the net operating assets from last year to current year is not a normal or a good proxy of the growth rate, we can take the average of the last 3 to 5 years. Because maybe there was an unusual event, something unusual happened from last year to this year, so you can always normalize the growth rate by taking the average growth rate over the past 3 to 5 years, okay? So this is our beloved firm again, Nike. This is its cost of capital. This is the return on net operating assets in 2010, calculated as operating income in 2010 divided by net operating assets in 2009. And this is the 5-year average growth rate of net operating assets. It was 4.6%. This is the net operating assets in 2010. And this is the growth forecast of the operating income. We multiply here, we multiply the return on net operating assets at time 0 times net operating assets at time 0. This is year 1. So this is the return on net operating assets in year 0 times the net operating assets at time 0. And the growth forecast of the residual operating income in year 1 is equal to the difference between the return on net operating assets in year 0 minus the cost of capital times the net operating assets in year 0. So this is the return on net operating assets for 2010. This is the cost of capital. The difference is multiplied by the net operating assets for 2010. This will give us the residual operating income for 2011. Okay? Accordingly, according to this assumption, the value of the common equity is equal to the book value in that year plus the capitalized residual operating income. We take the expected residual operating income in 2011, we divide it by the difference between the cost of capital and the growth rate, and this gives us the value of equity. We divide this one by the number of shares outstanding and we get this value. This is the value per share. At that time when this valuation was made, Nike traded at $74. Look at this value obtained here and compare it with the market price. Very close, huh? Very close. Okay, beautiful. Again, we can value the firm by subtracting NFA from the value of equity. So this is the value of the firm. Alternatively, we can value the firm using the formula. This is the current or the book value of net operating assets in 2010. And here, return net operating assets for 2010 minus the cost of capital times the net operating assets in 2010. This minus this times this is just the residual operating income in 2011, okay? We divide it by the difference between the cost of capital and the growth rate. Forget this one. This one is not, shouldn't worry about this one. Stop at this point, okay? The former two cases, for which are cases of simple forecast and valuation, usually these two cases may work for mature and well-established firms, because these mature, well-established firms, usually they have a stable income stream with maybe zero growth or a stable growth rate, okay? Sometimes when we deal with the startup firms or high growth firms, the former two cases cannot be applied. In this case, we need to make an assumption about the different periods growth rates. Remember, in the former case, we assumed a constant growth rate starting from year 1 onward. Okay? Makes sense? But sometimes a firm may experience different growth rates over different periods. Sometimes we can try to simplify the calculations instead of, for example, using two periods and a growth rate for each period. We can, for example, forecast the growth rate for the residual operating income by calculating a weighted average growth rate. Where, for example, the first weight multiplied by the growth rate in the residual operating income, and this is the second weight multiplied by the long run and sustainable growth rate. This is the long run growth rate. Now, the weight is determined by you according to your belief and calculations. It is not arbitrarily to be determined. You should base your calculations or the weights assigned based on something reasonable. So if you believe that the current growth rate can be maintained for 70% of the time, in this case you put a weight here 70 and here 1 minus 70, it should be 30%. Okay? If you believe this growth rate can be maintained for, let us say 30% of the time, then you should reverse the weights. You put 30% here and 70% here. Okay? Then you will get the weighted average growth rate. Okay? Make sense? So you decide based on the situations of the firm, the degree of competition, the external forces, the strength of the firm, its competitive advantage. You should analyze and decide. Okay? Another way to calculate the growth rate in the residual operating income is to use sales growth rate. Remember that net operating assets is equal to sales times 1 over ATO. However, ATO is usually stable or constant. If this is the case, then any change or growth in the net operating assets will be driven by the growth in sales, because ATO is always constant most of the time, okay? Because this one is almost constant, any change or growth in this one will be driven by the growth rate in sales. So we can use the growth rate of sales to forecast the growth rate in the net operating assets, as well as maybe the growth rate in the residual operating income. Make sense? Okay. This is another example. Have a look at these statistics or metrics for Coca-Cola. The profit margin from 2002 to 2007 was almost around 21%, right? Somewhere between 20% to 22%, somewhere within this range, right? And the ATO, as you can see, the variation was also small. It was between 1.3 to 1.35. So the variation is very small. We can take the midpoint, right? And also even the core return on net operating assets, also the variation is very small. The core return was somewhere between 27% to 30%. We can take, for example, the midpoint, or if you believe the latest one can be sustained, then use it. Okay? The average sales growth rate over this period, 2002 to 2007, it was 5.4%, and the cost of capital was 9%. If this is the case, then the value of this firm in 2007 is equal to the value of its, the book value of its net operating assets at that time, plus the capitalized residual operating income. This is the residual operating income calculated for 2008. We take the latest return on net operating assets, this one, we use it, minus the cost of capital times the current net operating assets, then we divide the answer, we divide it by the difference between the cost of capital and the growth rate, okay? So this is the value of the firm. At that time, the firm also had net debt of 5144. We subtract this one from this one to get the value of its equity. Please, this is a typo. This one should be 2007. Once we have calculated the value of equity, we divide it by the number of shares outstanding in order to calculate the value per share, okay? Again, this is a typo. It should be 2007. Any questions? Any questions? No? Okay. Okay, let us take a break. A break. I took this one with me. Okay, attention. Sorry. Back. Sorry. Sit down. Attention, please. Ready? Okay. Let us continue. The second part of the lecture talks about the full information forecasting. Very easy part, as we shall see shortly. We are going to see how to do full information forecasting and also pro forma analysis. Are you speaking? Did you say something to me? No? Okay. Note that the future financial statements are forecasted by the same drivers of the financial statement analysis. We need the growth rate of sales. We need also the operating profit margin. We need also the asset turnovers. Remember that these drivers, they drive the residual operating income, and these drivers also themselves are driven by economic factors. So you need to understand the business and the economic factors that affect your business in order to be able to calculate the correct drivers and use them in the valuation. So, before you calculate the drivers, you need to understand the business and also pay attention to some factors and considerations. First, we need to focus on the residual operating income and the drivers, and also focus on the change, and also the key drivers and the choice versus conditions. Let us discuss each one in greater details. Focus on the residual operating income and its drivers. Remember, the residual operating income at time t is equal to the difference between the return on net operating assets at time t and the cost of capital times the net operating assets at time t minus 1. Remember that this one is constant, but this one is variable and this one is variable. So these are the two drivers. These are the two drivers of the residual operating income. We have two drivers, the return on net operating assets and also the change or the growth in the net operating assets. The return on net operating assets is also driven also by some other factors. So this is how the formula can be written. It is the product of the core sales profit margin times ATO plus the core other operating income relative to net operating assets plus this one, unusual items. UI is the unusual items relative to net operating assets. This one in the forecasting can be ignored. We can drop it from our consideration when we do forecasting. Okay? When we do forecasting, we can drop it from our consideration. Remember that sales is the number of units sold times the price per unit. So we need to ask ourselves and find out the factors that drive the demand and the price. Normally, sales or the revenues figure, sales figure is the primary driver of the growth. The next important one is the core sales profit margin. We need also to be aware of the factors that affect the profit margin. And the third is the margin versus the ATO relative to the required return, or this one minus this one. Remember again, unusual items, these ones can be ignored or dropped out when we use or when we forecast the operating income and use it in the valuation. Once you have identified the drivers, the next step is to focus on any change or to figure out if there is any change. Now, in order to see or to capture any change, the first step, you need to establish the typical driver pattern for the industry. Normally, for each industry, there is an average driver. For example, maybe the ATO for automobiles firms is usually, for example, 1.5, something like that, for example. If you observe a deviation from this long-run average, do not expect this deviation to last forever unless there are genuine changes at the level of the whole industry. Otherwise, you should always remember that there is a mean reversion. It means that any deviation from the long-run mean will disappear with the passage of time, and the driver will converge towards the mean or average. Okay? The rate of reversion to the long-run level, called fade rate or persistent rate. Competitive advantage period is the period over which a driver fades to a typical level. We have mentioned these points before. If you still remember, I told you any unusual growth rate or whatever cannot last forever. You should always try to smooth it out or forecast the period over which the driver or the unusual growth fades away, okay? This is the case if there is a temporary deviation. However, sometimes we need to modify the pattern for forecasted changes. If there are genuine changes, for example, it might be the case that a certain industry is experiencing structural changes that will drive the level of its driver to another level that will be sustained into the future. If this is the case, then you need to update your calculated driver level, okay? To reflect the new change, okay? And also you need to forecast how a firm's drivers will be different from the typical pattern or the industry. If you believe so, you need to explain or to be aware why this is the case. And remember again, if your firm is growing at a growth rate far different from the rest of its industry and the economy, remember that this cannot last forever. You should always be reasonable in your forecast. You need to calculate and determine the period over which this unusual growth rate will fade away. Okay? These are the key drivers for each major industry. As you can see in the airlines industry, key economic factors. These are the economic factors that affects the drivers of the residual operating income. So these are the drivers of the residual operating income, and these are the factors that affect these two. Okay? You do not have to memorize them. I'm not expecting you to memorize these ones. Just understand them, okay? Don't memorize. You will not. It's very hard to memorize all of them. Just have a look and understand them. Keep the lecture notes with you for your future reference. Maybe one day in the future you may find them useful. When you read them again, you remember your lecturer Mahmoud and say, oh, this guy gave us a lot of details, yes? but they were very useful, hopefully. And also focus on choices versus conditions, or you need to make a clear distinction between strategic choices or decisions made by the management and those that are beyond the control of the management, such as business conditions. For example, government regulation, taxes, price, degree. These factors may affect the drivers of the firm, and these factors are beyond the control of the management, right? So you need to be, or to make a clear distinction between these things that are, for example, the product, location, quality, production process, R&D, alliances with other firms. These are decisions within the control of management. It is the management that decides for example, the product to produce, the location, the quality, blah, blah, blah. Okay? So there are some factors that are within the control of the management, and there are some factors that are beyond the control. Factors that are beyond the control of management might have a lasting effect. Factors that are within the control of management might have temporary effect. Okay? It depends. Because in practice, firms, they try to copy the strategies of each other. If a firm is doing very well by following a certain, for example, production process or strategy, other firms, they normally try to imitate. Okay? So managers, they copy from each other some decisions. Okay? Now let us see how to do full information forecasting and pro forma analysis. Remember, pro forma analysis means that we are forecasting the financial statements. This is what we are talking about here. So this process involves forecasting the economic factors and the full set of the residual operating income drivers. The starting point is to forecast sales or the growth rate of sales. This is the starting point. Next, we need to also calculate the core sales profit margin. Then we need to calculate the ATO. And also, if we have other core, the fifth one can be ignored. So the first three are the main ones. The fourth is also important. The fifth can be ignored. This one can be ignored, okay? Because the expected value of the unusual items is 0, okay? We need to focus on the core items. So back to our dummy firm. This is again the same statements presented at the start of the lecture. Let us try to forecast these financial statements for 5 years into the future, and see also how to do the valuation. Okay? Now, if you can do something like this, that will be very useful for your career and the future, because in practice, employers always they need financial analysts who can do reformulation to the financial statement and also can do forecasting. Okay? So it is very important to be able to do something like this. Okay. So we need first to identify the drivers. Assume that we forecast sales to grow at 5% every year. We calculate this one from our market analysis or taking the average over the past 3 to 5 years. If you believe the past will be a good indicator of the future, then use it. Otherwise, if you do not believe so, you need to do market analysis and see how much the firm or the growth rate will be in the future. Okay? Forecasted core sales profit margin is 7.85%. It is assumed to be the same as the current year. remember, core sales profit margin is the operating income from sales. Operating income from sales, this is 9.8, or sorry, operating income in general. Could you please divide 10.3 by 124? How much? Okay. So this is the operating income divided by sales, right? Okay. So 9.8 divided by 124.9. So we divide the operating income by sales. And the forecasted ATO is 1.762. It is assumed to be constant every year. Calculated as what? This is sales multiplied by 1 plus the growth rate. This is sales in year 1 divided by net operating assets in year 0. Sales in year 1 is equal to sales in year 0 times 1 plus the growth rate. Then we divide it by net operating assets at time 0. So this is the expected ATO. It is assumed to be constant every year. If it is assumed to be constant every year, then the implication, if you still remember, the implication of this is that net operating assets will grow at the same growth rate of sales. Do you remember? You remember? Go to the last slide of the first part of the lecture. Here, if you go to the last slide of the first part of the lecture, second last, not this one. Go to slide here. Another way to deal with the growth is to use the sales growth rate. Remember that net operating assets is equal to sales times 1 over ATO. We said that if ATO is constant, then the growth rate in the net operating assets will be equal to the growth rate of sales. You remember? For simplicity, we assume that there are no other core items or unusual items. So let us see how to value this firm and also do the pro forma financial analysis. So sales can be easily forecasted in the future. These are actual data. These ones. These are forecasts. So sales in this year, it was 124.9 times 1.05, the growth rate. We do the same here. This one, it is sales, this figure, times 1 plus the growth rate. This one is equal to this, times 1 plus the growth rate. Make sense? Every year in the future, sales in any year in the future is equal to the former year's sales times 1 plus the growth rate. We do the same for the core operating expense. This one we do the same. We multiply this by 1 plus the growth rate, we get this. We multiply this by 1 plus the growth rate, we get this. We do the same every year. The difference between sales and operating expenses, we get the core operating income. Note that we do not have forecast for the net financial expense or income, and we do not have forecast for earnings of the firm. But remember, when we discussed the residual operating income model last week and the week before, we said that to value the FAM according to this model, we do not need to forecast the net financial expense and earnings. We just need forecast for the operating income and net operating assets, right? Net operating assets are also assumed to grow every year at 5%. Every year, remember, it is growing at the same growth rate of sales. If we have the expected operating income and the forecasted net operating assets, we can value the whole FAM, and once we have valued the whole FAM, we value its equity by subtracting the net debt from the value of the FAM. Make sense? So what we have so far is enough to value the FAM. We need this figure and these figures, and we can easily value the FAM as follows. The value of net operating assets is equal to the current book value of net operating assets plus the capitalized residual operating income. As we can see, this is the operating income and this is the residual operating income. We calculate the first one. This one is calculated as 10.29 minus, this is the expected operating income, this one, minus the product of the cost of capital, 10%, and the lagged net operating assets, 74.42. Okay? So this is the residual operating income. According to our assumptions, this one will be growing every year by 5%. If you calculate the growth rate here, this divided by this minus 1, this divided by this minus 1, it will be similar to the growth rate of sales. So we can value the FAM as follows. We capitalize the first residual operating income. We divide it by the difference between the required return and the growth rate. We add it to the initial book value of net operating assets. We get the value of the FAM. Then the value of equity is equal to the value of the FAM minus NFO. So this is the value of equity. Make sense? So again, forecasting the operating income and the net operating assets are enough to value the FAM and its equity. Make sense? However, sometimes we are interested in forecasting also the financial statements. Maybe we are interested in forecasting the whole income statement, including net financial expenses and also earnings. Sometimes also we are interested in forecasting the balance sheet. We already forecasted the net operating assets, and we want to see how to forecast the NFO as well as equity. Okay? And also sometimes we are interested in forecasting the statement of cash flow. We already can calculate half of the statement of cash flow. Remember that free cash flow, C minus I, can be calculated as operating income minus the change in net operating assets. So this is the operating income in this year, and this is the change in net operating assets, this minus this. So this one minus the change in net operating assets gives us the free cash flow. Okay? Let us see how to complete the missing items in order to have full pro forma analysis. To do that, we need extra assumptions. One of them is about the payout ratio in order to see how much dividend will be paid out by the FAM, and another about the forecast, about the cost of debt. The cost of debt. Okay? Make sense? Okay. So let us see how to fill out the missing items. Remember that we already forecasted the core operating income for year one. Now we need to forecast the net financial expense at time t is equal to the cost of debt times NFO at times t minus 1. So we multiply the cost of debt, it is 4%, 4% times the lagged NFO. The lagged NFO was how much? 7.7. So 7.7 times 4% gives us the expected net financial expense. Okay? Make sense? Okay. The next step is to calculate. Note that this is negative. It means, because here it says net financial assets. Negative net financial assets means that the firm had NFO. Okay? This is the meaning. Now the next step, so we forecasted this one based on the lagged one. The next step, we need to forecast this one, the NFO for the next year, in year one. Very simple. NFO in next year, we use this formula. Do you remember these equations when I told you, when we first introduced them, I told you these equations are very important for the forecasting purposes. Do you remember? I told you these relations are very useful to do the forecasting. So net financial obligations in year one, this one is equal to the lagged one, NFO at time t minus 1, this one, minus the free cash flow, this is the free cash flow in this year, plus the net financial expense, this one, plus dividend, where dividend here is equal to the payout ratio times the earning. This is the earning. Remember, earnings here is equal to operating income minus net financial expense. Okay? Make sense? So again, this one, net financial obligations here, net financial obligations here is equal to the lagged one minus the free cash flow, this one, plus the net financial expense, this one, plus the amount of dividend, which is equal to 40% times earnings. Okay? Okay. Now, this minus this, or plus this one, keeping the negative sign here, gives us the common equity. Okay? Okay. Operating income minus the change in net operating assets gives us the free cash flow. Dividend here, this amount of dividend is calculated as 40% times earnings. So every year we multiply earnings by 40% to get the amount of dividend. Okay? Now on top of dividend we need the debt financing. So this is D and this is F. Debt financing is 2.58, can be calculated using one of two methods. Either, remember that C minus I should equal D plus F. If we have C minus I calculated here, if we calculate D here, then this free cash flow minus T is equal to F, because the two sides must be equal, right? Alternatively, F can be calculated, this amount can be calculated as NFO in this year. It is 5.43 minus 7.7 plus or minus, keep the negative sign here, okay? This is negative, okay? So the answer is negative 2.58. This is an outflow. We put it here without the sign because it is outflow. Okay? So it is equal to the change in the NFO, this minus this, plus the net financial expense. Okay? We do the same calculations every year. Here, for example, this is the net financial expense. We multiply this NFO by the cost of debt. We get the net financial expense. Then we use this formula to forecast NFO here. Okay? And then this minus this gives us this and the sum, this plus this here, the sum should equal here. So the two sides here are equal. Make sense? Okay? Okay. So this is the complete forecasting template. Have a look at this one and see the steps. Steps 1 to 6 and steps 9 and 10 require forecasting. All other forecasts are calculations from the forecasted amounts. So 1 to 6 and 9 and 10, these are items that need forecasting, and the remaining steps can be calculated from these steps. Only steps 1 to 7 are necessary for valuation. So from here to here are all what we need to do the valuation. The remaining items are to do like a pro forma analysis. This is true without stock options. If there are stock options, we should do some extra calculations to take into consideration the liability or the contingent liability arising from the option overhang, as well as the possible increase in the number of shares outstanding in the case the options were exercised. So we need to calculate the value if options were exercised and against value if the options were not exercised. Okay? Normally the best thing to do is to take the average of the two values. If the options were exercised, if they are not exercised, take the average. Okay? In this kind of analysis, it's always very common to do averaging to smooth the effect of extreme ends. Okay? So the features of the operating income valuation approach: it is efficient. We need these factors. Again, this one, remember, can be ignored. It also focuses on the part of business that adds value, the operations. Dividends are irrelevant to the valuation. We do not need it in the valuation. Financing also is irrelevant. We just need forecast operating income and net operating assets, value the firm, then we take into consideration how the firm is financed. After we value the whole firm, we subtract NFO from the value of the firm to value the equity. Okay? Zero net present value investments do not affect the valuation. Value generating investments are identified, and also we avoid the problems of the discount rate changing as leverage changes. If you go back to last week's lecture, when we developed the residual operating income valuation model, there was a case where the firm borrowed money to repurchase some of its shares, and there we said that if we are using the residual earnings model, we need to calculate the new cost of equity, forecast the new net financial expenses, calculate the new earnings, blah, blah, blah. We can save ourselves all of the time. We do not need to do all of this. We just apply the residual operating income model to save ourselves all of these steps. Okay? Okay. When we do this kind of analysis, it is not a bad idea to do something called scenario analysis. Under the scenario analysis, we try different values for the drivers and see how sensitive the value of our stock is to an error in the estimated drivers. Okay? For example, try different growth rates for sales and see how sensitive the value is to any error in our estimated growth rate of sales. The same applies to the profit margin and the asset turnover. Also try and see how sensitive the value is to different required returns. This will give you an idea about the vulnerability of your calculations and how solid your valuation is. Okay? Okay, finally, this is an extra part. I added this part last year. It is taken from this textbook required by the CFA Institute. Are you aware of the CFA charter? You know the CFA charter, no? Okay, beautiful. This unit is very useful for those who want to do the CFA charter, because second level, level 2, the weight of asset valuation is very heavy in level 2. So this unit is very useful for you. So to model revenues or to forecast revenues, remember in the past we said that so far we have used the growth rate in sales without knowing how to calculate the growth rate in sales. We said that, okay, we can take the average over the past 5 years and use it as a proxy for the growth rate in the future. Sometimes the past is not a good indicator of the future. So maybe we need alternative ways to forecast sales and revenues. When I'm talking about sales, I'm talking about revenues. Revenues and sales are used interchangeably, okay? There are 3 methods to forecast sales. Either we use the top-down approach or the bottom-up, or a combination of the two. According to the top-up, we start with the whole economy. I will show you the details shortly. When we use the bottom-up, we begin with individual product lines, locations, or business segments. We forecast the sales for each segment or production line, and then we aggregate all of them to get the forecasted sales for the whole firm. And also we can aggregate the forecast for all the firms in industry to get the aggregate revenues for the whole industry. Okay? We can do a combination of these two, where, for example, we may relate the sales of a given segments to some macroeconomic factors and forecast the sales of each segment, for example. Then we can combine the expected sales for each segment. We combine them together to aggregate or to get an aggregate figure for sales. So according to the top-down approach, we can either use the growth rate of the firm relative to the GDP growth, or we can do something else. We forecast the growth rate of the industry, and then we multiply the forecasted sales for the whole industry, we multiply it by the market share of the company. Let me discuss the first one here first. Are you aware of regression? Statistical analysis like regression, when you regress a variable on another variable. Are you aware of this one? You know how to do regression? Okay, beautiful. So what you need to do, you can take, for example, a sample. Let us say you take a sample from 2010 to 2018. You calculate the growth rate of the firm, the growth rate of the firm, the growth rate in the sales of the firm from here to here. And then you calculate also the growth rate of the GDP. This is the growth rate in the sales of the firm. And then you regress the growth rate of the firm sales on the GDP growth rate, the growth rate of the GDP. We are using historical data, actual data, historical data. We regress the growth rate of the firm on a constant plus the growth rate of the GDP. Once you regress the growth rate of the firm on the growth rate of the GDP, you will get the constant and the coefficient. Okay? Beta is the coefficient. Then all you need to do to calculate the growth rate of the firm sales, all you need to do is a forecast of the growth rate of the GDP. This one is usually available in the website of the central banks or the Reserve Bank of Australia. Here in Australia, the government bank or the central bank is called RBA, Reserve Bank of Australia, okay? Normally, the Reserve Bank of Australia and other government websites, they normally quote their expected growth rate of the GDP because it is a very important figure for policy makers. They need this figure to formulate their fiscal and taxation policy and spending policy, okay? So this figure can be, we use historical data, we regress, and then to forecast the growth rate for our firm over the next year or after, we multiply the constant, or we take the constant plus beta times the forecasted growth rate of the GDP. This will give us the forecasted growth rate of our firm. So if next year GDP is expected to be 3%, let us say this one, alpha is 2%, beta is 1.5. Assume that the government believes that the GDP will be growing or will grow at a 3% next year, then the growth rate of our firm is 2% plus the product of 1.5 and 3%. 1.5 times the 3% is 4.5, right? Plus 2, this is how much? 6.5%. So we can use this one as a proxy for the growth rate of the firm's sales. Make sense? Is it okay? Okay. Alternatively, we can relate the growth rate in the overall industry relative to the overall economy, forecast the sales at the level of the whole industry, for the whole industry, then we multiply the sales of the whole industry by what? By the expected market share of our firm. So that will tell us how much sales will be captured by our firm. Okay? If our firm, for example, if our firm captures 30% of the market share, then its expected sales is equal to 30% times the expected sales of the whole industry. Okay? Make sense? I'm not going to ask you to do something like this in the exam, regression. But I just expect you to understand what's going on, what we mean by that, okay? You understand what the idea here, okay? Okay. Approaches to modeling operating cost. In the former example, it was very simple example where we assumed that the operating cost will be growing at the same growth rate of sales, right? In the former example. But this need not be the case. Remember that operating costs are usually composed of two major components. The first one is called variable cost. This is the cost that varies with sales. And sometimes we call it cost of goods sold. Cost of goods sold. This one, the best thing to do is to assume that it is a fixed percentage of sales. This is the best thing to do. We see the average ratio between the variable cost relative to sales. If it is 60%, for example, this is the average ratio, then every year we multiply the expected sales by 60% in order to calculate the variable cost. Okay? Make sense? It is assumed to be a fixed percentage of the revenues. The second one is the fixed cost. The fixed costs, they do not vary with the sales, but it doesn't mean that they do not change. Remember that salaries and wages, they are a very important component of the fixed cost. Nevertheless, they do change every year. Okay? Fixed cost means that they do not vary with sales. This is the meaning. Okay? But they may change due to inflation. For example, firms usually they increase the salaries and wages of their employees at a rate equal to roughly to the inflation rate. So you can use the inflation rate, for example, to increase the fixed cost every year by a certain percentage, okay? Make sense? So you need to be dynamic. You cannot assume or assume too simplified or use too simplified assumptions. You should be realistic. Use realistic assumptions. Make sense? Something that reflects the reality. Okay. Be careful that sometimes there are costs included. Sometimes the fixed costs are called SGA expenses. Be careful. Some of these are usually called fixed costs, and these are the variable costs. Be careful. Sometimes certain fixed costs, they are aggregated under the fixed costs, but they are in reality might be or may vary with sales, such as, for example, commission that are usually given to sales representatives, for example. They might be aggregated under this figure. So you need to be careful. Sometimes, for example, marketing, advertising expenses, they may vary with sales as well. So you need to be careful. Double check and see whether they are constant or variable, or they vary with sales. If they vary with sales, it is better to isolate them from the remaining SGA expenses and forecast them separately as a certain percentage of sales. Make sense? Make sense? Okay. This is it. A very useful lecture. Maybe this is the ultimate end. This is the last step in the financial analysis. If you are able to do forecasting, then the next step is to do valuation. Remember that you need to do the proper reformulation of the statement before you do the forecasting. So you reformulate the statements, isolate operating items from financing items, focus on the core operating items, forecast them, then you can value the firm, okay? Any questions? If it was feasible, by the way, if it was feasible, I would have given you the assignment today. If it was feasible, I should give you the assignment today, if it was feasible. I'm not going to do that, I'm just... If it was feasible, because by now you are able to do everything from the scratch. Okay? But it wasn't feasible, that's why we gave you all the inputs ready to use in the assignment. But after this lecture, you should be able to do everything from A to Z. I will see you next week.
I have a question about the assignment for
use the next job. Multiply the average price. Use the next job. Yeah, use the next job earnings multiplied by the average price. Okay? Most welcome.
Dude, imagine standing behind, yeah. Dude, it doesn't really matter, yeah. Might be a bit more daunting. Actually, this was a massive lecture for them. It's like 20 bucks. So that's 60 hours.
This will give you the terminal value here. Still you need to discount it to the group. So this is the dividend in 2024. So this times the number on growth rate. So divide this one by the difference between the required repayment and the growth rate of the GDP. Get the terminal value here. This discount this one to the present and add it to the present value of the
It's classic.
Here's the two. The one I give
That would go like right.
Yeah, that many teachers in grad school is like copy the rest of
Did I tell you the next
the
two?
burden on your kid, but hey.
Take the last year June, earning per share multiplied by 1 plus the growth rate, that will give you next June earning per share. Use it in the price to take the average price to earning ratio for the comparable payments. Take the average and multiply. Where is the residual earnings number? Where is your residual earnings number? Show me. Show me the table. Did you value the firm using the residual earnings number? Okay, where is it? Okay, where is it? Yeah, so this is your June 2019 earning per share. Multiply this one by the average price to earning ratio. This is it. Multiply this one by the average price to earning ratio for the comparable firms. That's it. You'll get the price. Yes. Not to discount. Take this earning ratio, multiply it by the average price to earning ratio for the comparable firms. Where is the comparable firms? This is the, I'm talking about the method of multiplying. Up, go up. Wait. Where are the comparable firms? So this is the price to earning ratio for the comparable firms. Take the average of these and multiply it by the earning per share. That's it.
Yeah, thank you.
Most welcome. Come on, guys. Next, please. I'm not going to be there. Yeah.
When we're presenting it, is it in our tutorial class or
Yeah, during your workshop.
so when
Your tutor will evaluate you.
so but for some
Yeah, I mentioned something about that. Let's do
you do it the last but you have to learn that you
You should remind him in the week after. Okay, but do not ask your group mates, all of your group mates, to do it next week because of you. Let them present next week and you can do it alone the week after. Okay, but let your tutor aware of that.
Hey, I'm just gonna ask him if we can like chuck these in the appendix. Yeah. What did you need to talk about?
Let him email me so I can write a note.
Cut down smaller.
Ask him to email me.
Yeah, I still don't think that's gonna, because we're at 11.
Is he the road link?
We're at 11 pages. Yeah, and Ben's parts.
There is a student
2
who
more
emailed me. I
pages,
told him
and he
to
hasn't
submit
added that
it
in
later
yet.
on. I told him he can
So
submit
that
it.
there is like another 2 pages. Yeah, so like there's really like nowhere to save space.
Anyway, but
I don't
there
really
is a
know.
case, maybe this is the same guy. I asked
Yeah,
him
you
to
can have a
submit
look at it.
his own.
Yeah, because there is a little explanation about the smaller the size. Yeah, it is the explanation of this smaller size?
Yep. Yeah. It's,
So cut down this one.
you
or
don't think
just
we
leave-
need that?
You want to help him?
We need that.
I think we do.
But will he submit in his own name, not in your name?
In his own name.
Or here.
Because his drinkers aren't really very helpful to me.
Is that necessary? Yeah, that is necessary.
Okay, give him guidance, but don't be too deep. Don't write anything like that.
Yeah, we'll just see what he
Give him
says.
some guidance. Because
It's looking pretty good.
before this kind of a sign.
I think it looks good. I just need to finish my part off.
That's good. I won't write anything, I'll just
Just give him guidance.
with verbal. No, thanks for you.
Anyway, I was just wondering, because we're like at the limit for the number of pages. Is it possible to
How many pages I say? 12?
12? Yeah, and we're
All inclusive. Don't go beyond that.
including your reference to the end of the page.
Reference is just at the end of each page, man. Just write the reference at the end of each
So you
page.
don't
Show me.
want...
This is your report?
Yeah, this
Looks
is...
nice, no?
You want to have a
It looks very neat.
I don't know, because we're at 13 pages and we have one more group member who's doing management and governance, and he said his part's another 2 pages, so that's a 15-page report. If we do an appendix, would that be? Would you
What
be
is the
counting
font size?
12? Yep, it's 12.
Reduce it to 11.
Reduce it to 11. Will we get marked harshly?
No. Just try to see if there is irrelevant data or something or information. Try to be very concise.
Yeah.
Sometimes a very big paragraph can be simplified into 2 very concise lines. So try to be very concise.
Okay.
Something like that. Okay?
All right. No worries.
Down to 12 pages. Okay.
Yeah.
That's it.
That's what we spoke about.
We'll just try and go down a bit more.
I just wanted
What
to
part
know,
did you
is that
do?
road rent the same? Long
This
rent.
is the last year's, this is the dividend per share in by the end of our horizon.
Yeah.
We multiply by 1 plus the long run.
Oh,
Not 1 run, 1 plus the and
Okay,
then
so
we
it's-
divide,
I reckon that looks
then we
good.
divide
Yeah,
by
probably.
between the required return and the
Who did industry?
Oh.
Yeah.
fantastic. And then that's the terminal value.
I think that, like all this, can be like
We'll
shrunk.
give you the terminal value, not the CV.
I think that was.
Yeah, it is the same. It is the quaternion value. It is calculated in the same way like the quaternion. It is just the name.
Yeah.
The name is terminal value, but the formulas we use to calculate it is very similar to those used to calculate the quaternion value. So this is the dividend. You multiply by 1.
Should we change this here 2.1?
So now you divide this one by this one.
Oh, is that 2.4? Yeah, just. Oh shit. Right. Oh wait, no, it's 2.1. Yeah. I don't know, just like when I uploaded it to Google Docs, it like changed it. But like it's all good in this one.
Set it up now.
Just divide this one by the difference, okay? By the return and by the rate, then the run of the rate. Okay. Should be something maybe around 30 or something.
Oh, so this one is it's pretty close.
So it is here. You have how much? 2.3. Divided by
This one? Yeah. So just put it there.
divided by the difference. Divided by the difference.
You probably just need to leave that in there because there's a video on there that will link.
Oh, okay. So just in
Yeah,
case, yeah.
Just in case.
Okay.
Otherwise the video won't work.
Oh, is it? It's got with the
It's hooked in.
hooked in with the. Okay.
Yeah.
Okay, your calculation is correct.
Oh, fantastic. Thank you so much.
Got the
Pointer.
fantastic.
So the forward and back,
Yeah.
and you can also do like pointing.
Yeah.
With this red. Yeah.
With that red bit.
Yeah.
Beautiful.
Great.
Thank you very much.
All right. Well, we still have a time.
Yeah.
Time maybe. Yeah. How are you? How are you?
I'm good.
Yeah, sorry they are to bugging you like.
No, that's
I
fine.
understand
It's
that
just
you're
I've been-
really busy.
Yeah, and it was just more too that I was just making sure
Yeah.
that I could get the content together.
Oh.
So this is